Netflix's stock dropped 30% when the market opened on Wednesday, instantly wiping more than $45 billion off the value of the company. The sharp drop in Netflix's stock price came after Netflix reported it shed 200,000 subscribers in the first quarter of the year, when it had been expecting to add 2.5 million. This is the first quarterly loss of subscribers in more than a decade for Netflix, far underperforming expectations and worrying investors that have been long-time believer in the company to continue growing at a rapid pace. Is it game over for Netflix? Well, let's take a look at what caused the drop in Netflix's subscriber base first. Netflix blamed the subscriber loss on a price increase for their standard plan, as well as password sharing among users. Management estimates password sharing is happening in more than 100 million households, including over 30 million in the US and Canada. This is a shockingly large number considering Netflix has 220 million total global paid users, which means almost half of the subscribers have shared their accounts with someone. But even though this is definitely one of the barriers to Netflix's subscriber growth, it is definitely not the only one or even the most important one. Let's be honest, shared accounts have been around since Netflix was launched. The bigger problem here is Netflix is going to lose its pricing power, as well as its value proposition to its competitors. The company is now facing more competition than ever before, from both established tech giants and traditional cable companies who are all getting into the streaming market. Disney and Comcast are both launching their own streaming service to try to stem cord cutting, as well as other established tech giants like Amazon and Apple that are getting into the space. Also, the macroeconomic environment isn't helping either. With inflation hitting a record high, families have to reevaluate their budgets, and entertainment services like Netflix are often the first one to get crossed off the list to compensate for higher food and energy prices. And it really seems like inflation isn't going away anytime soon. So that's going to be a headwind for Netflix. Looking forward, Netflix's management said they expect the subscriber base to rebound in the second half of the year. But analysts are skeptical that the company will be able to continue its torrid pace of growth given the competitive environment. The stock is down more than 60% so far this year, and big changes have been made to reverse this downward trend. In the conference call, CEO Reed Hastings has indicated that he is open to the idea of having a lower price or free version that is ad-supported. Hastings has long been against the idea of an ad-supported business model in the past, but that view is changing as the company has reached almost full penetration in the potential addressable market. Now management expects to launch an ad-supported version in the next 1 to 2 years, and acknowledges that going too fast will likely see certain subs moving towards this lower pricing tier immediately. It seems like ultimately, advertising is the inevitable path to higher count monetization, as Netflix's biggest competitor Disney has also announced it will have an ad-supported tier coming later this year. As a leader in streaming, Netflix is likely to do very well with advertising. But is that enough to attract subscribers? Is pricing the most important factor in this question? At the end of the day, people subscribe to Netflix for their great movies and TV shows. So increasing the quality of the content on the platform will be the key driver for Netflix's growth. Netflix is currently spending about $18 billion on content production every year, and it is unlikely the company is able to increase its content spending even more to stimulate growth. The silver lining in this situation is that Netflix is still the largest streaming company in the world, and there is a possibility that it might be able to acquire or merge with other streaming companies. If Netflix is facing some tough times, so do the other streaming companies like Paramount Global. If there was indeed a merge, Netflix would be able to gain extra content and programs, as well as a lot of intellectual properties of some of the most well-known TV series. But time is ticking for Netflix to retake the lead in the streaming space, so it has to act fast. Can Netflix produce better movies and TV shows to attract more subscribers, or acquire some important players in this market? Time will tell if Netflix can rebound from this blow. But for sure, the company faces an uphill battle in the coming months. This is Money Therapy, a channel about money. See you in the next one.